Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest-running radio programs, also a top financial planning podcast. Check out our website at Nelson Financial Planning to learn more about us, along with how you can connect with any of our social media platforms. And certainly, you want to check out our social media platforms this week because we got some cool pictures from sort of our shenanigans of Halloween on Friday, which featured a host of people.
Absolutely. The whole office contributed.
Yeah.
I was quite impressed.
Very impressed. We had the whole Teenage Mutant Ninja Clan.
Yes.
And then we had a couple of people coming as me, which...
Amazing.
Yeah, exactly. I mean, I mean, how delightful is it to dress up as a middle-aged man with receding hairline? I mean, it's fantastic. Okay. Anyway, my name is Joel Garris, the guy with the receding hairline and middle age. And then joining me on this week's program, Christina Lamb. Both of us are certified financial fiduciaries at Nelson Financial Planning. We're to learn more about the serious stuff that we do. You can check out our website at Nelson Financial Planning and see how we can help you make better decisions with your money. Speaking of decisions with your money, Fed had a meeting this past week, obviously cut rates. That made a lot of headlines. That was probably the big headline for this past week.
Yeah, quarter-point drop.
Quarter-point drop indeed, and then had the opportunity to join our good friend Simon Conway on his program Good Morning Orlando on Thursday morning, and to kind of discuss some of the things or the implications of what this rate cut meant, along with kind of thinking about what the future may hold. As always, when rates change, there's some winners and some losers when rates change. That's for sure.
Yeah, absolutely. Depending on what you're using the money for, it can be a good thing or a bad thing when rates get cut.
Yeah, I mean, that's true. Certainly on the plus side, when rates go down, that's good for things like mortgage rates. That's good if you're borrowing money for a car. If you're, unfortunately, have some credit card debt, that also means, though, that at least that rate went down from like 24 to 23.75. But still better. Obviously, you know, rate cuts have a tendency to be a little bit more stimulative in nature for the economy as a whole.
Yeah. But on the negative side, if you're just savings money in like a cash account or something like that, then your earnings are going to be going down. So you're not going to be making as much interest as you previously were. And right now there's about $7 trillion sitting in cash out there.
Like a record level.
Absolutely.
And so, all those folks saw their interest that they're making on that certainly go down. And I think that opens up the conversation about, okay, well, what other alternatives are out there in terms of where to kind of invest the money, which is a much bigger conversation. I think we talked at length about that a few weeks back on the program in terms of thinking about other options, like maybe tax-free munis if it's money in the after-tax account. By the way, those don't work very well in a retirement account because, of course, it might be tax-free, but when you take the money out, it's still taxed as ordinary income. So I always like to point that out because you'd be surprised at how many times we've seen like a tax-free muni fund inside of an IRA. It's crazy.
Right. It really makes sense how you utilize it.
Correct.
Definitely in the non-retirement.
No, absolutely. And then, the other part is the rest of the story, right, with the Federal Reserve and kind of its messaging post the rate cut, because the interest rate cut, usually indicates that something's not totally perfect in the economy. And so when we think about kind of the data, you could certainly argue that the unemployment rate, which creeped up to 4.3% in August versus 4.2% for July, not necessarily a great sign. I mean, there could be some explanations involving AI behind that, but old data. I mean, here we are in November, and we're talking about unemployment data from August. There's a bit of a gap in terms of kind of what they were able to wrap their hands around.
Yeah, the government shutdown is definitely impacting things and not getting all that information out there that we should be. And I thought it was interesting too. The Fed chair mentioned that there may not be now a rate decrease in December, so that's leaving some questions in the air. But inflation data was also up a little bit from 2.9% in August to 3% in September. So while those numbers are also lagging due to the government shutdown, it's still a little bit of a decrease there.
Yeah, I think that's part of the problem, Christina. To your point on the government shutdown, is here we are. We're talking about data from August. We're talking about data from September, and sort of somewhat operating in the blind. And I think that's why the Fed chair, after the meeting on Wednesday, really tried to kind of temper down what those expectations might be, because they're really sort of operating in a little bit of a black box.
Yeah.
And then you also have all these companies that have been announcing some significant layoffs of late, large companies.
Yeah, I noticed that as well.
Yeah, Amazon was one of the ones that, I mean, there's been a lot of them that have announced this. And it's interesting. I wonder if they're doing that when, like, the data isn't getting reported, right? So,
right, if that's like a true number.
Right.
Yeah.
Right. So you're doing it and you're staying under the radar, so to speak, in terms of kind of how it all...
Half the information's not there.
Yeah. And then nobody's reporting it, so, must be okay. But that's a significant backdrop that we have to understand and appreciate in terms of where we are in the environment today, particularly when we think about interest rates.
Yeah, definitely.
Yeah. So then, but despite that, the major indexes kept, kind of moving on, and of course this is earnings season, big week for that.
Yeah, absolutely. Earnings, 1/3 of the companies reported this week, plus lots of corporate deals that are going on in the background. So total corporate transactions are up 36% so far this year.
Yeah, and I think that's just kind of representative of the current environment. Obviously, it's a less regulatory environment in terms of the current administration. And so you're seeing that deal-making kind of really increase over the course of the year so far. But, again, it does, and this is kind of the theme that we've been talking about so far in the program, is all of this warrants still, to not just put your head in the sand and say, hey, everything's great, my accounts are making money, life's grand. But you really do have to continually check that investment allocation, not just for, under concentration of international or over concentration of some of this AI tech stuff, but also basically the balance between stocks versus bonds, because that also has been changing on you.
Yeah, absolutely. I think that's great advice, because let's say previously your allocation is 70-30, meaning 70% stocks, 30% fixed income. With all the growth we've had, you're more in like an 80-20 allocation, so 80% stocks, 20% fixed income. So you're overweight in your equities, which makes your portfolio a little bit more aggressive than you'd want it to be. So it's important that you either speak to your advisor, look at it yourself, and reallocate as necessary.
No, I think that's very, very, very true. So if you've settled on sort of a 70-30 type of allocation to meet your investment goals and objectives and all of that, and you haven't looked at it for maybe 6 months or 12 months, then yeah, you're kind of probably maybe not all the way to 80-20, but certainly if you haven't looked at it for a year, you probably are, which means that your portfolio has more risk. So that's something that we talk to clients an awful lot in the office on a daily basis about rebalancing. Absolutely. And kind of looking at that overall conversation. Important to kind of really look at that at those details. Yeah. That's for sure.
And that's sort of like an annual checkup. That's something you should be doing, I would say, at least once a year. Always just making sure you're kind of in line with, where you started out being and where you currently want to be.
No, that's exactly right. And I think to sort of segue to our next topic, thinking about the things that you need to look at as an investor and what's important in terms of your finances is this distinction of sort of good debt versus bad debt, and kind of understanding the difference between the two, because obviously these changes in interest rates certainly impact that.
Yeah. So, I thought as we get into that leverage conversation, is borrowing always bad, or, can it be a secret weapon to help you build some more wealth?
Yeah, no, I mean, I think that's a great way to kind of describe it. Debt at the end of the day is about borrowing money. Leverage is about borrowing money, but not all debt is sort of created equal. And we're going to kind of parse that in a little bit more detail when we get back from this break and kind of get into the discussion of good versus bad debt, and then sort of segue into how we're seeing it used, unfortunately in a negative way, in more investment products. So stay tuned after the break and hear more here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.